Be going. Are we going? Whoa. Check, check, check. Okay, let's see. Got it. Got it, got it, got it, got it, got it. All right, now let's double check. Where's Twitter? Not there. Okay. Nope, I'm going live on Twitter. Hey, let's go. Oh, all right, this is awesome. Let's go, let's go, let's go. Well. It is 7. So I hope. Let me just. Oh, yep. I see you live right there. Okay, let me just double check. Go through a couple more things. Um, make sure I'm going live. Check for my personal Twitter. I feel like that's always key, just to double check. Aha. Yep. There I am. Yeah. So what's going on, everyone? Welcome to another episode of This Week in Crowdfunding. I know it looks a little bit different. It's because I'm home with my parents, so I'm celebrating some, good family holiday time, Christmas time with my parents, my family, my aunt, my grandma, my grandpa. They're all coming in town. I'm super excited. I hope y'all are having a great time and super excited for this upcoming holiday, Christmas. It's a wonderful holiday, my personal favorite, and then New Year's Eve afterwards. So it's going to be a big 2024. Super excited. We got a lot of stuff planned. We'll get to that later. Well, as it gets closer to 2024, we'll tell you more about it. I do want to show you all real fast. I got this hat. I like it all. I thought it's pretty cool. It's a Sitco hat and it says feeling good. That's how I feel right now. Feeling good. Yeah, nice pun. Anyways, we got a couple stories I want to talk about today, and I'm super excited to talk about them. So, both stories, they're both from Crowdfund Insider, which if you have not seen or do not know about Crowdfund Insider, I highly recommend you check them out. It's a great news source. So it has all the crowdfunding information, and it's really good at just constantly keeping you in the loop and writing really good short articles that just help you understand the landscape and what's happening. And it's easy to track, easy to follow. They got a great Twitter too. I think it's Crowdfund Inside. Maybe one afterwards. Great Twitter. Check them out. Um, but overall, I really like using them to get my news on the crowdfunding industry. So the first one, let me share my screen real fast. Uh, let's see. Let's see. Okay, can you see? Can everyone see that? Yeah. So this is the first story. So I call this the good, the bad, the ugly, maybe. So the SEC is looking to review the definition of an accredited investor. So right now, an accredited investor earns over 200,000 a year or has a net worth of $1 million. If they're married, however, they have to earn over 300,000. That's the kind of accredited investor basic threshold you have to meet to become the accredited investor. This helps you get into deals that you wouldn't have access to if you're a non-accredited investor. So I think it's very it's not important, but it just gives you more of optionality if you're an accredited investor. And oftentimes the deals that accredited investors get into are the deals that are a little bit more risky but end up having a higher return. Like any private equity deal, venture capital, usually you have to be an accredited investor. So let's start with the good. I like starting with the good news first. So here's the good news. The good news is the SEC's looking to the SEC is looking to review the definition of accredited investor. So I think that's good. Brendan and I have been talking about this, and there's more and more momentum pushing to get the SEC to revisit the accredited investor rules. We suggest that there should just be a test. It should be a test that you can take, you study for it, you take it, kind of like I guess like let's say like the Series 7, right? You just study for it, you take it. Maybe it's like it's a month worth studying. Obviously, it has to be a test that really test you. It can't just be an easy like, oh, you just show up and get an A, right? They need to test you to make sure you actually understand it. So maybe like book, study for a month, then take the test. I feel like that's very reasonable instead of just basing it off how much someone makes or their total net worth, because that doesn't always indicate their financial literacy. So that's the good news. The SEC is looking into it. Now, we're going to get to the bad news. So, as you see, as we scroll down here, um, so the bad news is they talk about this, most people understand wealth metric is not the best metric to determine accredited status. SEC has been slow to expand the definition. However, this is the kind of the bad part, which is that they're thinking about possibly excluding more individuals from the accredited status. And the biggest argument is that they want to adjust for inflation. Yeah, I know. Like, what? Why are you adjusting for it now? You should have adjusted for it back when it was really, really high, and now it's coming down. Now there's room, and now you want to adjust it. That doesn't make sense. And then ultimately, that decreases the amount of people that have the accredited investor status. And if you look at it, it is where is it? Okay, so man, where the heck is it? Okay, the current accredited investor definition is over inclusive, right? Encompassing individuals who may, right here. Current accredited investor definition is over-inclusive, encompassing individuals who may not be able to bear the risk of loss of the investment or who are not in the position to access the information needed to assess the risk of investments because financial thresholds contained in the definition have not been adjusted for inflation, or because net worth calculations include certain assets such as retirement accounts that should be omitted. Emphasis added. Now, that is major. So, what this basically, the SEC is saying that this definition's over inclusive. We're allowing people to now get in these deals that are too risky, that don't really understand it, and we want to help. I don't think that's the right approach. I think you should offer them the option. You should always offer them the option, but you should, instead of protecting them, educate them. That's the big thing. If you want them to get the status, don't make it on a benchmark of wealth or how much money you make, but make it on the material and actually like passing a test. Just like when you have to drive a car, you have to pass a driver's license. And one, you have to be able to drive, but then two, you also have to take a written test. So why don't they do the same for this, right? And so now they're saying too, which I don't like, is now they want to exclude certain assets. They want to exclude retirement accounts. And here's the crazy thing. This article gets into it later. So this is where it gets ugly. They want to remove retirement accounts from consideration for accredited status. And they did the calculation. If you remove retirement accounts that are included in, the net worth to get you over $1 million, if they remove that, then the number of households that qualify for accredited status go from 16.44 million to 11.6 million. Yeah, basically 33%, just by removing retirement assets. So I'm trying to understand, why would the SEC want to do that? Like, if you really want to protect these individuals, you would educate them. The goal is in education. The goal is not by raising the threshold higher and higher and limiting the supply. You educate them, you make it possible so that it's available for anyone who wants to get it, as long as they're willing to do the education. But by increasing the threshold, which it's kind of looking like the SEC wants to do that, I think it's the exact opposite direction of where the SEC should be going. So I see that I don't know if scare is the right word, but that's a little intriguing to think that the SEC is going that route. That doesn't make sense to me. Maybe someone else can come on and tell me why they think the SEC would be going that route and trying to make it. They claim it's over inclusive. Clearly, there's a lot of emphasis on retirement accounts should be omitted. And trust me, I understand they want to protect these individuals. I get that. I'm all for protecting them, but protecting them by giving them education, not protecting them by limiting the optionality, because I think that's a very slippery slope. And going down that road ultimately leads to the people who then have access to the better deals, continue to have access to better and better deals. And the people who don't have access, that gap widens to where it becomes really, really hard to then ever get any sort of access to it, right? At least with education, if you want it, you can go learn it. You can then pass the test, right? I know I keep harping on this point, but I just think that makes the most amount of sense. So uh, I do have a silver lining. I like to be positive. I like to always try and see the glass half full. So the positive thing is that if they remove the retirement accounts and the number of accredited investors, decreases by 33%, that's really going to impact the participation in Reg D offerings. However, now those individuals don't have the accredited status, so they can't partake in that deals. So that might increase the amount of investors in the Reg CF offerings that partake in the Reg CF industry and the Reg CF ecosystem. That's the best silver lining I can find. Um, we'll see what happens. I think there's going to be a lot of backlash and pushback on if the SEC actually goes through and increases the threshold that an accredited investor has to have, like yearly income or net worth. I think there's going to be a lot of backlash and pushback on that. So I think it's going to be really hard for the SEC to pass that. And I guess the only silver lining is that maybe that means more supply for the investors that partake in the Reg CF offering because they don't have access to the deals they want, and so then they start looking to the Reg CF offerings. That's what I think. But thank you, Crowdfund Insider, for this article. It's very interesting. I do think we are gonna get to the point to where there's going to be a test. I honestly do. I think that makes the most amount of sense. I think it's only a matter of time before the government can figure out how they can create the test and figure out how to monetize from the test so that they're incentivized to use the test as a form of licensing for accredited investors instead of doing you know salary or net worth. So it will happen. We have to speak it into existence. It's only a matter of time. So now the second story. The second story, let me pull up my notes, and then let me share the screen with you. And it's right. Wait, yo, Cedar. Yep, yep. This is really exciting. So I totaled this up. This is the future is looking pretty bright, and as you can see from the headline, Cedar publishes report platform performance claims 18% IRR, topping VCs. Very exciting headline. And we were talking to Woody, and he was saying, the biggest thing is just gathering the data, putting the data out there. This is from C Clear. They do a great job getting the data from all the Reg CF offerings, and they can basically show how these offerings doing, how the amount of money they're raising, the amount of number of deals. It's great. They have a great monthly report. They're saying, one of the biggest things getting more people into this ecosystem is by showing, what's the ROI, what's the IRR from making these investments over a long enough period of time. Once you start showing the data, it's kind of hard to say no. It's like, why do people invest in the stock market? Well, on average 8% year over year. So you invest money on average 8% year over year. It's going to continue to grow, except this year. This year's crazy. That's beside the point. Fun fact, I didn't realize that the NASDAQ was up 43% year to date, which is just bonkers. We'll see what happens. So, okay, so basically, Seedrs. So since 2012, IRR of the portfolio that's raised on this platform is 18.36%, and the comparable to that with VC firms were 17%. So beat the VC firms, which is super exciting. Which means that now a non-accredited investor has access to opportunities that they didn't have access to through VC firms that have often been looked at as some of the best, most risky, but if it pays off, the highest return, one of the highest returns, investing wise. So I find that super exciting. And then here's some interesting points. And this kind of goes through. I recommend just check out Crowdfund Insider. It's a great great news source. But you can see, yep. And then if you don't know the difference between IRR and ROI. IRR factors time value of money. So they use discount rate. So this is a lot of banks, a lot of financial institutions use IRR. Um, ROI, there's no factor of time value of money. There's no discount rate. So that's just in case you didn't know. And then okay, here I love this. So Seedrs is a two-sided marketplace where we empower our investors to make active choices in the market and have full agency over their portfolios. We are not advisors, but facilitators connecting founders with ambitious investors. And I love that because at the end of the day, some of the biggest, most successful platforms, all they do is just connect, supply, demand. They just create a marketplace where the supply and demand can mingle and they connect the investors, the founders. It's a great way. And once again, it's just you're providing more opportunity for these investors, especially since for a lot of these deals, if it's a Reg CF, you don't have to be accredited, which is awesome. So that means you get to invest in these startups and you don't have to meet the accredited investor status. And there's no other place like this where you can invest in these startups. Obviously, it's very risky. I have to keep saying it is risky. There are risks to it. You have to know how to do your due diligence, research on the company, really understand what you're getting into. But once again, I get excited just because it's an option. And having the option is the best route to go. And then educating them before they make the decision. That's what you need to do in order to mitigate the risk. But taking the option away, to me, I think that's a terrible decision. I always think that will be a bad decision just because I don't think that's the right way to go about it in the long run. Um, Let me just check the Twitter stream real fast. Uh, okay. I want to see. Okay. Can I hide? Hide. Can you hear me? Okay. I think you can hear me. All right. So, yep, you can hear me. All right. Yeah, sorry. I had to wait for the feedback in my headphones. Um, but okay. So this I think this is really exciting too. If you look at okay, so this data is from 12/31/22. So I would assume because this was a great year for RegCF and a lot of the equity crowdfunding in the ecosystem as a whole. A lot of these platforms did really well. So I would assume that these numbers hopefully increased. I guess we'll find out when we talk to Woody in January. You're going to want to tune in for that. There's going to be a lot of great data. I'm always super excited. Woody and Yvonne, they do a great job. See Clear, super excited for that. But what's interesting is that you look, okay, so success rate was 80%. So for a lot of these offerings, you only get your money once you successfully reach your goal for your round for whatever you're raising. So if you're raising $80,000, if that's the goal, you will have access to that money once you hit that goal. If you raise over it, then you can slowly kind of take money out. But that's why the funding success rate. That's why there's a metric called funding success rate. So that means 8 out of every 10 startup hit whatever goal that they set, which is always a good sign. That means clearly that there's enough demand for investors wanting to invest in these startups and willing to invest in these startups. To me, I see that as a sign of a growing market. Now, 284 companies successfully raised. So that was in 21 though. That'll be interesting to see what it is in 23. I love this stat, right? There are 18 companies that have raised on Seedrs that are now worth more than 100 million pounds. So that's probably got to be, I don't know, somewhere like $120 million, I think, something like that. And then one company that raised money on Seedrs that's now a unicorn. So, I mean, that's what you're going for when you invest in these companies. You're going for unicorns. So, the fact that there has already been one, and now the deal flow is getting better and better in this industry. So, super promising sign. Super excited for that. Yeah, pop the champagne, right? Let's go. Anyways, the so what's interesting is the top sector raising fintech. Uh, I don't know. I find that interesting. I think more D2C in the future, just because I think they're gonna realize the power behind getting a community with these equity crowdfunding raises. And once again, me and Brendan always talk about this. The goal, I mean, when you do these equity crowdfunding raises, you turn customers into investors into advocates. And there's a famous Paul Graham Here's a famous Paul Graham quote. That's he says, "You would rather have 100 advocates, 100 people that love your product, than a million people that kind of like your product, because those 100 people are gonna talk to more people and like another 100 people and advocate and get them to become loyal fans, and then those people are gonna tell more people, and eventually it just creates the virality growth. So that's the name of the game. But with this, with equity crowdfunding, with crowdfunding in general, you really you really help curate advocates for your product. That's only if you have a good product, you curate those advocates, and then those advocates tell more people, and then next thing you know, now you have a real community, a real loyal community, and that's worth so much more than just a ginormous community of people that kind of like your product but really don't care that much for it and aren't that loyal. So yeah, I think that's a interesting trend that I will be excited to watch in 2024. And then another massive point is almost a quarter of the offerings were female founders. So we had Jessica Millstone on, when was it? She's the GP of Copperwire Ventures, and she was on maybe a month and a half ago, 2 months ago. Yeah. Uh, she's a great VC, super smart, invests in a lot of ed tech and a lot of female founders. And she highlighted one of the biggest issues with the VC industry is just the disparity between female and male founders receiving investments. So I think there was a stat in 2019, out of 100% of the VC capital that was allocated in 2019, only 2% went to female founders. So you think about that, and there's that's just such a massive. You're talking about 2% to female founders, 98% to male founders. That's just insane. So the fact that a quarter of these offerings had female founders, it's really helping address and attack that disparity between male and female founders raising capital in venture capital markets. Uh, and you can also throw minority founders in with those female founders too, just with the disparity raising capital. I know that's a big issue, and there's a lot of. I talked to EHAR, and EHAR focuses on funding immigrant founders, just because that's all. There's a massive disparity there, and helping address that issue is a very big problem that they're trying to help get right, get more even. Yeah, so that's exciting. And then it is important to note 56 companies have generated exits. Many of these have generated a loss for investor, and then 21% have failed in the winding down process. Like, as again, these are risky investments, right? You're not doing this to get your 8% year over year, right? You want to do that, just invest in the stock market. But this is to invest in companies that you either love the mission, you love the product, and they have a chance to 100 1000x. Like, there's that chance. And you're not trying to break even on most companies. You're just trying to make sure that you've not, I don't want to say find the ones that hit it big, but you don't want to miss the ones that 1000x, right? That's kind of the numbers game with this. Since it's so risky, you don't over invest. You kind of budget it out, kind of have a bankroll, kind of like it is with playing poker, right? Where you kind of understand you can't let your emotions get the best of you, and you allocate a certain amount to each investment. And then you end up having, I think a typical angel investor will have 90% they lose all their money, 5% they break even. I think then like 2% they 2x their money, 2% then maybe like 2% they like 3x their money, and then 1% they like 10x 20x their money, something like that. So it's it's risky, uh, but it's an opportunity, and it's exciting, and you get to you know this is an opportunity to invest in these companies that are going to change the world, that can change the world, that are ambitious, that are attacking real problems. And yeah, I love it. So yeah, I thought that was a great article, and it does a good job pointing out the good and the bad, but there's so much promising potential in this industry. And it seems like every single day there's more and more momentum getting behind it, and more people getting involved, getting excited in the industry. And once again, I can't stress this enough. It's just the fact that we have the opportunity. That's awesome. you have the opportunity to invest. You don't have to invest if you don't want to, but at least you have the opportunity. And then if you want to invest, now it's your turn to do the due diligence, right? And to really learn more about the company, research the founder, research the market, and do your due diligence before you invest. So, with that being said, kind of wraps it up. Um, yeah, I hope you enjoyed it. I appreciate y'all. Y'all have a great Christmas. Christmas is Monday. So have a great Christmas. Enjoy the family. Enjoy the good quality time. Brenton and I will be back. I guess that will be the 27th, 28th, that week from today. So Brenton and I will be back. You'll have a great Christmas. And we appreciate you. And see you next time on This Week in Crowdfunding. And check out Crowdfund Insider. Great source to get your crowdfunding. Appreciate y'all. Thank y'all. Have a good one.